Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at unusual machines.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis of unusual machines. For any sophisticated listener, this company really presents a classic high-stakes puzzle.
Right.
Can this explosive defense-fueled growth actually outrun what is, let's be honest, an extreme valuation risk?
That is the core question, isn't it?
Yeah.
And I think the first thing we have to talk about is the recent financial momentum. The story here really, it really shifted in Q3 2025.
It absolutely did. That quarter was the company's first ever profitable one. They reported, $1.6 million in net income. That's about 5 cents a share, a huge psychological milestone.
But you have to look behind that number.
You do. A big piece of that, I think it was $5.8 million, came from unrealized investment gains.
Okay, so let's unpack that for a second. That means the actual business, selling drone parts, that was still operating in the red.
Exactly.
But their investments, maybe in securities or other assets, basically saved the quarter on paper. So it's a profitability shift coming from the Treasury Department, not the factory floor.
That's the key distinction.
Right.
They're not operationally profitable yet, but it does show they're managing their capital exceptionally well. And speaking of capital, their balance sheet is just rock solid.
Rock solid is an understatement. They're sitting on, over $133 million in cash, and critically, zero long-term debt. That gives them so much flexibility in a really capital-intensive industry.
And that cash pile translates directly into, phenomenal liquidity. They have a current ratio right now of 51.4.
51.4. That's just insane.
Right.
For anyone listening who isn't tracking this daily, a healthy current ratio is maybe 2.0.
Right.
51 means they could pay their short-term bills 50 times over. It's a fortress balance sheet. It tells you they are ready to...
And ready to spend is right. That fortress lets them get extremely aggressive with growth. They've been busy. They closed a big $48.5 million financing round in Q3.
And they didn't stop there. Right after that, in October, they did a very successful ATM offering.
At the market, yeah.
Raising another $72.1 million. That's over $120 million raised in just a couple of months. Well, it's a frantic race for cash. What's the huge opportunity that's driving that?
It's necessary because the growth they're forecasting is just extreme, and it demands huge capital deployment right now. If you look at the consensus revenue estimates, they're projecting $8.63 million for 2025.
Okay.
But the estimate for 2026 jumps to $21.29 million.
Wow, that's a 147% year-over-year jump in revenue. Yeah, it looks great on a spreadsheet, but operationally, how do you even do that? How do you scale 147% without major quality control issues?
Well, you build the infrastructure first, and you secure an exclusive market, and that's exactly what we're seeing. They just opened a brand new 17,000 square foot motor manufacturing facility in Orlando.
Right, bringing production in-house.
All about controlling the supply chain to handle that growth. And the emphasis is on domestic production, which is, as you said, the whole ballgame. They also leased a massive 25,000 square foot warehouse and fulfillment center.
Also in Orlando. So they're building the physical capacity to meet those forecasts.
But the real competitive moat isn't just physical, it's regulatory. Their whole strategic focus is on manufacturing NDAA-compliant drone components.
And for the listener, that regulatory focus is probably the single most important factor here. NDAA is the National Defense Authorization Act. What does that compliance really mean for their bottom line?
It means they're perfectly positioned for U.S. government procurement. The U.S. government has basically mandated that defense agencies can't use components from certain foreign countries.
Creating a protected market.
A massive protected market for companies that are NDAA compliant. This validates the high valuation way more than any piece of tech ever could. They're essentially selling regulatory paperwork that's wrapped around hardware.
And we're already seeing proof that this strategy is working. The contract wins are coming in.
Absolutely. They got a big $800,000 order from Red Cat, but the real headline was the contract with the U.S. Army 101st Airborne Division.
That Army contract is huge. It specifically calls for 3,500 NDAA-compliant motors and several components from the highly scrutinized BLOE UAS list.
The government's trusted list, yeah. Things like the Aura analog camera and the Brave flight controller. That listing is a massive barrier to entry for any competitor. It proves they can service major mission-critical defense clients.
Okay, so this is where we need to pump the brakes a little.
Sure.
The growth story is exciting, but let's talk about the other side of this. The risk profile here is pretty significant.
It is. We mentioned that Q3 profitability was helped by investment gains. If you look deeper, the operating income, what the business actually makes, is still very negative. The last reported figure was minus $7.2 million.
So they were still burning cash from operations. They're basically paying for that 147% growth with the cash they raised.
That's it. They have the runway to do it. But it does raise sustainability questions if contracts don't start translating to positive margins, and soon. And this leads right to the biggest problem, the valuation risk. It's enormous.
Oh, enormous.
The company is trading at a price-to-sales multiple of 59x. To put that in context, when you trade at 59 times sales, you are priced for absolute perfection.
Right, like a startup that's already expected to be the next Amazon.
Exactly. The market expects that 147% growth to happen flawlessly.
So any delay, any slight disappointment,
Yeah.
any hiccup in the supply chain could cause a pretty severe correction. There's just no room for error built into that share price.
And flawless execution is hard when you're scaling this fast and integrating acquisitions like they did with Rotor Lab. It's just a lot of moving parts.
That operational risk is real. You can't just flip a switch on a new factory and expect it to run perfectly.
To their credit, though, they are trying to address that execution risk by hiring top talent. The recent appointment of Al Ducharme as VP of Engineering is seen as a very, very positive move. He's expected to really bolster their R&D.
And in this space, you need that. The tech has to evolve with the contracts. Okay, so moving to the near term. What are the catalysts? Investors don't have to wait long.
No, we have a few fixed dates coming up.
Right. We have November 29th, 2025, which is the Q4 ETF rebalancing. That can influence liquidity and maybe put the company on some new institutional radars.
Then just a few days later, December 3rd, we expect some broader drone sector reports to come out. Good news there could give the whole sector a lift.
And looking into the new year, the company itself is setting expectations. There's talk of a major purchase order announcement around January 15th, 2026. If that PO is substantial, that could be the massive catalyst everyone is waiting for.
And then we get the full picture. The Q4 and full year 2025 earnings report drops on February 7th, 2026. That's the moment of truth for operational margins.
And technically, the chart looks pretty positive right now, reflecting all these wins. We've seen a recent bullish structure, higher lows, higher highs. It climbed from around $13.80 to $16.38 pretty strongly.
Yeah, the immediate support looks solid around $15. That's critical. The resistance we need to see it break is at $16.60. A decisive breakout there could open a path towards, say, $17.50 to $20.
And the analysts are reinforcing this.
That's right. The consensus is overwhelmingly positive. Multiple analysts have it as a strong buy, with an average 12-month price target around $19.33.
Strong buy ratings, a potential technical breakout.
Yeah.
That's a recipe for excitement. And of course, that excitement is fueled by rumors. The speculative buzz is pretty high.
It is. One of the biggest rumors is about international expansion. There's chatter about advanced talks with European defense agencies.
Cracking the European market would be huge. And then there's the administrative speculation. Talk about an uplisting from NYSE American to the Nasdaq Q.
A classic move to get more institutional ownership and analyst coverage.
Right. And finally, the M&A chatter is interesting because it cuts both ways.
Yeah, that's a good way to put it.
On one hand, you hear rumors they might acquire a drone software company. But on the other, with their position in the NDAA space, they're constantly rumored to be an acquisition target themselves for a much larger aerospace player.
The company offers a compelling blend of defense-focused secular growth and rapid financial acceleration, supported by an insurmountable regulatory moat. However, investors must weigh the extreme 59 times price-to-sales valuation against the critical need for continued, flawless contract execution and margin improvement in the coming quarters. It's a compelling risk-reward scenario, but one where the risk of disappointment is priced extremely high.